Over the last quarter, we saw the SGH Enhanced Income Trust return 1.4% after all fees and before franking credits, outperforming the benchmark by 4 basis points. Over the period, we did see the floating rate investments perform in line with expectations, with very little movements across cash rates here in Australia. On the fixed interest side, we did see a little bit of volatility. So when we turn our minds back to November, when President Trump won the US election, he announced his intention to introduce a number of tariffs. That was seen slightly negative by the market, and the expectation was that tariffs would increase inflation, which would lead to higher interest rates. And what we saw on the back of that was the 10-year US government bond increased by 0.7% to 4.5% over the quarter, and the Australian 10-year government bond increased by about 0.4% to slightly below 4.5% over the same period. This was a minor negative for the fund, but we did see all the rest of the investments perform in line with expectations. If we cast our mind over the next 12 months, we do expect the RBA to reduce interest rates by about 0.5 to 1%. And in Australia, we expect the RBA to decrease interest rates by about 0.5 to 1% over the next 12 months. And that will be continuing to support our narrative for increase in our fixed rate exposure and decrease in our floating rate exposure when opportunities present themselves. The portfolio is positioned to perform well in high stress environments. Now, we did see minor tick-ups in the bond market over the last quarter, and the portfolio still performed exceptionally well despite the volatility that was experienced. We continue to see opportunities within the fixed income space, and we'll continue to reduce our floating rate exposure as we have done over the past 12 months. The whole reason that we think interest rates will continue to decline in Australia is for 2 reasons. The first one is a continuation of weakness in the private sector, and then also slower inflation. And both of those indicators will translate into lower interest rates over the next 12 months. Over the last quarter, we haven't had any material changes in the SGH Enhanced Income Trust. We still expect that interest rates will continue to drift downwards, and that would warrant us to continue to increase our exposure to fixed rate bonds over floating rate bonds over the period. When it comes to credit events, the most important thing is the health of US and Australian companies, and the balance sheets at this stage seem very strong, which means it's going to be quite a strong demand for credit over the next 12 months. There are 3 main reasons why I think investors should consider investing in the SGH Enhanced Income Trust. The first one is where the interest rates at current levels and the portfolio returning just over 7% over the past 12 months, after fees and before any franking credit benefits. It's a great return and a great diversifier across any portfolio. The second one is many people still have money in term deposits, and this trust will continue to outperform bank term deposits by about 2% over the medium term. And the last one is the US market has been very hot. We are hitting constant record highs, and this is a great opportunity to diversify away from equity markets and more into some stable credit investments.